Hey everyone, welcome back to the channel, your number one source for income-oriented investing. Let's be honest everyone, when it comes to investing in the stock market, one of the easiest, more, very mainstream, very simple, very low cost, low fee is investing in an index fund or an ETF that tracks an index. So when it comes to the US market, the overall American stock market, in my opinion, the best one or the one that really captures the entire market is the S&P 500, which is the top 500 most important companies on the US stock market. And on the Canadian side, you have the TSX 60 index, which I typically refer to as the S&P 500 of Canada, which is really the top 60 companies in the Canadian market. So with these two indexes, you're really capturing the entire stock market. Big advantages, right? Low cost, no need to stock pick. You have all the stocks in proportion because they are not equally weighted. They're market cap weighted. So the bigger the company is, the bigger chunk it'll be part of the index, or the bigger percentage it'll be of the index. So you have automatic rebalancing. It's very, very simple, very easy, and it really works well long term. But they don't have much yield, right? So as income investors, if you invest in a TSX 60 index, maybe you'll get 3%, 3.5% if you're lucky yield, because there are a lot of dividend stocks in Canada. On the US side, S&P 500, you're only looking at maybe 1.5%, because there's a big chunk of those companies are technology companies that don't have dividends. So you're only looking at about 1.5% yield. Great for total return and growth over time, not that great for income, us investors who want income every single month. So is there a way to actually invest in these indexes with an income enhancing strategy like covered calls, where we could get 8, 9, 10% yield with monthly income? The answer is yes. And there is a lesser known provider, covered call ETF provider in Canada called Evolve ETFs, which I really like because they have they did a really smart thing. They basically came out with two index based covered call ETFs, and in fact, one is ESPX, that is the stock symbol that covers the S&P 500, that is the Evolve S&P 500 Enhanced Yield Fund, and there's also ETSX, which does the exact same thing but covers the TSX 60 index. So you're literally investing in the indexes, and Evolve is engaging or doing their covered call strategy on them to really enhance the yield. And the yield is a lot higher than just the indexes. We're talking, over 8%. So in this video, let's review these two ETFs together. We'll see what they're all about. We'll check out the management fees. We'll see the composition, when they came out, the yield that you could get right now, and we'll also compare them to some very popular or bigger existing enhanced income covered call ETFs in Canada and see how they're doing. They came out recently, but we could actually check the performance because it's been a little over 6 months. So let's check out these two ETFs together, because if you're an income investor like myself, like index investing, they could be a great fit. Let's get started. All right, everyone, let's review these two ETFs together. We'll start with the S&P 500 one. So it's ESPX, everyone. And by the way, if you just Google SPX, SPX is the S&P 500. So just a reminder, this is listed on, it is the S&P 500. It's all American companies in here, but this ETF is listed on the Canadian stock market on TSX. So you don't have to worry about that 15% withholding tax if you hold this ETF. It's Canadian listed, which means you don't see the 15% withholding tax. It's all managed by the fund manager. It's all included. So ESPX, what does it do? It basically tracks the S&P 500, or the performance of the S&P 500 index, with the addition of enhancing yield through active covered call strategies on the underlying securities. So when it comes to Evolve's covered call strategy, I really like it because it's an actively managed strategy, and they only write calls on up to 33% of the portfolio. So by default, you're capturing 66% of the upside of the S&P 500, but it could be much more than that, because just because they're writing calls on a third of the portfolio, it doesn't mean they're always at 33%, and it doesn't mean that, also the calls could be out of the money. So this is an actively managed covered call strategy, which I like. I personally always prefer the actively managed ones over the systematic ones. And as you can see, here, the level of covered call option writing may vary based on market volatility and other factors. So it is up to 33%, doesn't mean they're writing at 33%. So you could capture actually much more than 2/3 if the S&P 500 goes up. So this is very interesting. It just came out at the beginning of the year. So this is a rather new ETF, but one thing that caught my attention is the really competitive and low management fee typically for covered call ETFs in Canada, especially ones that are actively managed, it's the average management fee is 65 basis points, 0.65. So that's a good thing. The distribution frequency is monthly, and of course we're all interested right away in the distributions and the performance, right? So let's look at the distributions first here. So the monthly distribution has been the same since the beginning, 15.5 cents. So that's going to translate to a yield. You actually have the yield right here, but this is based on a couple of weeks ago. So 15.5 cents times 12, that will give you the annual distribution rate of $1.86 a share. So I'll just calculate the yield real quick based on today's stock price that I'm filming this video on October 16th. Of course, this is always going to change. Right now, the stock price of this ETF is 2072. So you just do 186 divided by 2072 times 100, and you have an approximately annualized yield if you buy this fund at 2072. Of just under 9%. So yeah, much higher than that 1.5% the S&P 500 gives you, right? So what's inside this ETF? It's really the S&P 500. That's pretty much it. So if we look at all of it, you actually see that 30% is in IVV, and IVV is just the BlackRock S&P 500 on the American stock market. So it's comparable to VOO from Vanguard. And then you have all, or most of all, the S&P 500 constituents here. So Apple, Alphabet, Microsoft, Amazon, Berk, etc., etc., etc. You actually see, if you click on overview, sorry, it's right here, number of holdings 502. So you're really investing in the S&P 500 here. And if we scroll all the way down, it has all the companies, and as you know, the smaller the company is, the smaller percentage it's going to make, but it's going to have in the index here. But one thing I saw that was really interesting, we could actually see all the covered calls, and they've taken an interesting strategy where they are writing covered calls on some individual companies here, but also on IVV itself. You see that here. So I thought that was very interesting. They're writing calls. They're not just writing calls on the S&P 500, on the SPX. They're actually writing calls on the ETF, IVV, and some individual companies. So it really looks like they're taking an active approach when it comes to the covered call writing, because they could just write calls on the SPX, for example, on the S&P 500, but they decided to go do a little bit, dig deeper, and maybe more an active approach and more analytics involved to really do it on the individual companies and the S&P 500 itself on IVV. So I thought that was very interesting. So really nice yield of just under 9%, everyone. It's a brand new ETF. It's been out for less than a year. It's already at 56 million AUM, which is pretty big for a Canadian ETF. So very, very popular. They have a hedged to Canadian currency version, that's ESPX. They also have an unhedged one. If you like the US currency and you don't want the hedge to Canadian, you could get SPX.B. They also have a USD currency version, ESPX.U. So keep in mind, all three of them are going to be listed on the Canadian market and traded in Canadian dollar, except the .U version. It's going to be bought and sold in USD, just in case you have USD. So very, very interesting, really an easy ETF to understand, right? S&P 500 with covered calls, with an active covered call approach, on a maximum of 33% of the portfolio. So what could we really compare this one to? Because there are a lot of US focused covered call ETFs. The one that comes to mind right away is ZWS. This is probably going to be the biggest and most popular one, managed by BMO, that has 174 million in assets. And one thing I'll notice right away is the management fee is 20 basis points higher than ESPX, so that's already an advantage for ESPX. And also, it's not really the S&P 500. They're basically choosing about 25 or 30 dividend-paying stocks on the U.S. market instead of just getting the S&P 500. So how does that translate when it comes to performance? Well, let's check out the Canada Stock Channel performance tab. We put in ESPX, we'll put in ZWS, and we'll compare them. Now, keep in mind, you got to take this with a grain of salt, because ESPX has only been out for less than a year. So this is just that time frame. But you could see that ESPX is really outperforming ZWS here. Total return is much higher on the ESPX versus ZWS. So I guess just choosing the index works over stock picking. Another one that we could compare it to is USCC. So USCC is kind of the S&P 500, not exactly, with covered calls from Horizons. The yield is a bit higher. The management fee is even a little bit lower at 39 basis points, so 6 basis points less. And if we compare it to ESPX, we'll do that now. Let's see here. USCC is doing just a tad better. So all to say, looking at these performances, keep in mind this is just less than a year. ESPX here is very competitive, very competitive compared to what's available on the market. So I think this is a great option if you just want you love the S&P 500, you're an income investor, you want monthly income, you want a nice approximately 9% yield. This is a great option to consider. Now let's look at ETSX, which is basically the same thing on the Canadian market. So ETSX, everyone, pretty much the same exact concepts, strategy, cover call strategy, monthly income as well, same management fee and everything, except that this is going to be on the TSX 60 index, right? So this is going to be a way to capture all of Canada. So stock symbols is ETSX, again, listed on the Canadian stock market. So this one here, you have an approximate yield of actually 10%. So, and that makes sense because the Canadian market has really been suffering lately. So of course, the more the stock price goes down, the higher the yield is. So right now, as I'm filming this, it's $20.72. Now the monthly distribution is a slightly more for, I'm sorry, I went on the wrong one. So the monthly distribution for ETSX is 16 cents a month. So if we translate that to annual, it's $1.92. And if we just divide it by the current stock price of $18.58, so if we do, well, actually, let's just refresh it now because the stock market's open. 1870 now. So if you do 192 divided by 1870 times 100, your yield would be 10.26%. That's, of course, if you buy it at 1870. So really nice high yield of over 10%, everyone. We know that the TSX 60 has a lot more dividend stocks. You're making about 3.5% yield just owning the index. So, by writing covered calls, you could easily get another 7%. In my opinion here. So really nice yield of over 10% right now. Of course, number of holdings 62. This is the TSX 60, so 60 most important companies in Canada, market cap weighted once again. If we look at the portfolio real quick, you'll see the classic Canadian market sector allocation, most of it in financials and energy. So if we scroll down, they kind of did the same thing. They actually have XIU, which is literally the TSX 60 index ETF. I think XIU is actually the first ETF ever created in the whole world. So yeah, a big chunk in that. And then you have the 60 stocks, the 60 constituents. You'll recognize all of them. Of course, Royal Bank and TD near the top. Enbridge is going to be near the top. The railroads, Canadian Natural, which is the biggest oil and gas producer, Shopify. So just the top 60 companies on the Canadian stock market by market cap. So the bigger the company is, the bigger percentage you will have. And if we scroll down, if we look at the calls, you'll see pretty much the same thing. They're writing like ESPX. They are writing the calls on some individual companies. So this is definitely an actively managed covered call strategy. And let's see if I could find if they're writing a call on the index here, like they did on ESPX. Yeah, here it is. So here is a call on XIU. So pretty cool approach. They're writing calls not only on the ETF, on the TSX 60 ETF, but also the individual companies. And again, this is only up to a third of the portfolio. So another great option if you like the Canadian market, you want to invest in the Canadian market without stock picking, you want a really nice enhanced yield of over 10% now. And by the way, these two ETFs, they don't use leverage at all. So if you don't want any leverage, these are great options to capture the whole American and a whole American stock market with ESPX, the whole Canadian market. Sorry about that. This one here, the whole Canadian market with ETSX. Very interesting. So what can we compare ETSX with? Well, the first thing that comes to mind is ZWC. ZWC is absolutely huge and humongous. You see that it's over 1.5 billion. It's been around for a really long time. You see that the yield is lower, the fee is higher. What about their performance? Now, if we compare ETSX to ZWC, of course, keep in mind this is only within not even a year's worth because ETSX only been around for less than a year. We see that ETSX is beating ZWC within that time frame by quite a large margin here. Well, actually not that large, but it's still beating it. You see here the numbers, and you could check out the performance, of course, which is going to change every day. So lower fee, higher performance, higher yield. It's as simple as that. Another one we could compare it to is CNCC. So unlike USCC, which is not exactly the S&P 500, CNCC really is the TSX 60. If we look at the holdings, it holds HXT, which is Horizon's TSX 60. So this is pretty much equivalent to ETSX. The only thing that's different is the covered call strategy. Horizons could do covered calls on up to 50%. Another thing, the management fee is a tad lower with CNCC, just like USCC, again at 39 basis points. And ETSX could only go up to 33%. So probably less covered calls on ETSX. Let's look at the performance. I'm very curious about this one. Let's see here. Compared to CNCC, wow, it's actually beating CNCC. I can't believe it. That's incredible. By a tiny bit. So again, super competitive here, these two index-based covered call ETFs to some competitors. So yeah, that's pretty much it, guys. I hope you really understand how these ETFs work. They're very simple and easy to understand. They're literally the indexes with a covered call strategy, actively managed, which I like, on up to only a third. Max is a third of the portfolio, so you capture most of the upside of the TSX 60, of the S&P 500 when they're going up. So very simple, easy options to add to your portfolio if you like index investing, but you want to get a 9-10% yield and monthly income, because you're an income investor. And keep in mind that the monthly income will be very tax efficient, because all the covered call income, which is going to be most of the fund, especially with ESPX, right? If the S&P 500 is only giving you 1.5% yield and this ETF is giving you 9%, well, almost all the income is coming from covered calls. With TSX 60, some of it's coming from dividends. About 3.5% of this 10% yield is going to come from dividends. So it's going to be eligible dividends, very tax efficient. The rest is coming from covered calls. And remember, guys, covered call income in Canada is classified as capital gains, not forward income, not regular income or interest income. So it's very, both of these are going to be extremely tax efficient, great for non-registered accounts as well. So there it is, everyone. Two super, index focused, income focused as well, ETFs to highly consider, in my opinion, if you are an income investor.